Good afternoon, ladies and gentlemen, and welcome one and all to this afternoon's US CPI event. It's currently 11 minutes past 1 GMT, and we've got the news coming out in approximately 19 minutes. What we're going to do today is we're going to talk a bit about the CPI, think about the figures, the analyst expectations, what the previous CPI figures were, also consider the macro theme, of course, what the Fed will likely interpret from the data, the pressure, of course, that's on the Fed at the moment from the White House, and what that translates into in terms of our trading activities for the day ahead for this afternoon. So, as I say, good afternoon. Hope you're all doing well. Hey, Braden, good evening to you, sir. Hello there, Davison, as well. Good to see you, mate. And I know more people are dropping in now. Good afternoon. Good afternoon. Good to see you guys. Good to see you all. So, yeah, it's going to be a busy one this afternoon. Now, the markets have been at a complete standstill, I would say, over the course of the last, half a week. It's been painfully slow. Really has. We're seeing that end of quarter slow down. Obviously behind the scenes, we're, going to be looking at potentially a lot of commercial repositioning here. Even the market report this week and the commercial data that's inside that report showed some really big shifts in where the liquidity was in the market. So I think we're going to probably continue seeing that towards the end of June. Good afternoon, guys. Yeah, good afternoon. Good to see you. So, yeah, there's a lot going on behind the scenes at the moment from a commercial perspective, from that institutional perspective. Of course, the retail trader side of things, you're not really going to see too much of a shift over in that. But it's not been easy to navigate. Now, we did incur a couple of losses yesterday. We also incurred a couple of wins. Pound yen, for example, was ongoing at the moment. No, it's not. Beg your pardon. Look at the damn thing. It just hit TP. So that's nice. That's actually, I tell you what, that's a good way to start the session this afternoon. Pound yen has officially hit target. Literally 15 minutes ago when I was looking at my MT5, it was still ongoing. But yeah, it's obviously just spiked up. And the UJ, I'm sorry to rub it in, Scotty D, if you're there. Yeah, I know you are. Yeah, there you are. So yeah, I'm sorry about your USD yen experience yesterday, but that one did actually hit TP after triggering as well, so that was nice. But we did take a couple of losses yesterday as well. We took a hit in the USD Swiss short, so that was 0.25%. Gold was really bloody disappointing as well. It triggered our trade idea. Where are we now? So I believe yesterday afternoon, didn't it? Yes, so it was that high. So our point of liquidity that we were looking for the break of structure from was there. I've cleared down the trades, of course, as you can tell from yesterday's book, so ready to get going for today's. But yeah, my trade triggered here as per the trade ideas that were released yesterday in the book building session, and instantly went to stop loss. I say instantly. It was over the course of a few hours after, so we did come down. We did trigger the stop at about 12:30 last night, which is a real shame. We actually came up again, but I wasn't feeling the second attempt anyway in gold, especially after what had happened yesterday. I was going to suggest to you guys thinking about a break close and a retest strategy outside of here, actually. So looking for the BCR continuation away from liquidity. Now that we've seen that the breakout has not worked, maybe we can install a new process, and get us in on that one. But anyway, today isn't really about that, guys. Today is about the US CPI. So CPI, big inflationary metrics used by economists around the world to really try and get a grasp on where inflation is. Now, we've got 15 minutes before this big batch of data comes out. This is the highlight data set of the week this week. Core inflation rate, the annual rate here, and the base inflation annual rate are the two that you really want to be watching. So at the moment, we're looking at a 0.2% increase on the base annual rate and we are looking at a 0.1% increase on the annual core rate. Now, if this is correct and the analyst expectations come out on point, you've got to think, okay, it's going to be pretty bad in terms of stock market trading activity, and I would expect sell-offs in the US stock markets as a result of increased levels of inflation. But on the flip side of that, you also have to take into consideration that whatever you read on the print here in terms of the economic calendars, it will be priced into the market to a certain perspective, right? So you're going to be looking at some of that being priced in versus it actually being quite detrimental to stock performance, overall stock indice performance. If it's a miss on the numbers, stocks will fly. I have no doubt whatsoever. They will fly. The Dow Jones might not so much, but NAS 100, possibly the S&P as well, propped up by those tech stocks. I do expect those to really start jumping around and having a pretty decent rally as a result. A win on the numbers, so in those levels increasing, is going to be detrimental to gold. It will be beneficial to the United States dollar in its current position, with dollar trading, still trading sub 100 down here. So, 99.036 at the moment, still trading underneath the belly of this huge daily point of liquidity here. So if we get a breakout today on a good CPI print, we could likely see the break above 99.50 and possibly get a price rally, I would say, targeting at around 99.90 to 100. So that would be quite decent. And then you would look at something like the Euro USD, for example, probably being pushed down to around our target. So that trade idea is yesterday's trade. Obviously, we're still waiting for it to come up and gather liquidity up at the highs here. Doesn't look like it's going to do that unless the CPI print is a miss. Of course, the dollar then deteriorates. Euro, as a direct result, will rally from that. So that's pretty much where we are. Now, we can obviously take into consideration the monthly figures as well, the core rate monthly and the base rate monthly, of which the core rate is a 0.1% increase and the base rate is stable at 0.2%. So, they do come into play, but really it's all about the annual figures, right? That's the one that we really want to be watching. So I don't think, if the core rate is a miss by expectation of 0.1%, but all the others come out above, you will still see the kind of market impact that we're hoping to see, a big one, I would say. So what we're going to do then, let's go back over here for a moment, keep that DXY. What we're going to do is we're going to build out a little bit of a trading book for this afternoon's trading event. We are going to be focusing our attentions on break of structure trades only. And we are also going to be risking no more than 0.15%. Now, and this is not, news trading is not for fun. News trading is a business just the same, but there are variabilities that we have to deal with whilst news trading that are not the normal presets that we could see in trading at any other time of the day. So things like spread variability, okay? You get spreads will vary widely during news events like this, okay, as most of you guys know. So we have to take that into consideration. This is why I would usually use very aggressive entry formats and get in right upon the breaker structure points rather than a bit of a margin above or below. Yes, this increases the chances of getting wicked into trade, but it also takes away some of the, let's say, I don't know what the term would be, takes away some of the wounding from slippage, and we will all be affected by slippage. There's no doubt about it. I think the last NFP I did a trade, it was a 1 to 2.4, and I actually netted a 1 to 1.58. That was on the last NFP just last Friday, or the last Friday. So yeah, it can be pretty bad even for me. So you do have to take that into consideration. Now, with this gold at the moment, I want to be looking at a TP of around there. Okay, I like this level. I don't want to go to the major highs, but this looks like a pretty decent point of inflection that has been utilized in recent activity. It's quite a jump from where we are at the moment, which is why we're actually going to be utilizing the double top that we've recently had as our breaker structure access point to this trade idea. So then we're looking for a trade idea entry above there, targeting up at the highs at 33.69. And our stop loss is going to be nicely tucked in there at about the 50% point between the margin of the breaker structure and the liquidity point below. This is yielding a 1 to 3.2, which is actually pretty damn good. Of course, that 1 to 3.2 is going to translate into 1 to 2.5 or 1 to 2.7 with the slippage. So that's something that we can look and focusing our attentions on there. Now we also have an ascending level through the lows. We can point that one out. And then we've also got, I would say, we've also got like, these major lows down here. So looking at this as a trading margin. Now, if we get that breaker structure, we copy and paste that and we bring that down to this area in here. I think that's actually quite nice. It makes perfect sense. We've had points of inflection over time. It's not the point of inflection, but it's certainly decent enough for a breaker structure. So then I would like to place a short in gold based on this clearing out the majority of the TRFs. We've got the point of interest down at 33.04 for the target profit. Again, I'm going to have my stop loss, not the 50% point because that's too gracious on this one. So I'm going to have my stop loss down at around 33.31, and that's going to yield a 1 to 3 as well. Probably going to net around a 1 to 2.4, 1 to 2.5. And so that was looking pretty decent as well. So that's going to be gold. Now, guys, just bear in mind, okay, we've only got 9 minutes left to go. So if you want to explicitly follow me, appreciating this is going to be uploaded to YouTube. So if you are the type of person that is not going to use this for informational purposes only, then please bear in mind we are cutting our risk as a result of the news event. Okay, we are likely to take a lot of losses. Okay, we are. That is the nature of this, which is why we manage our risk out appropriately. So 0.15 is the maximum. I would suggest even going down to as low as 0.1. With the decent risk reward, you're still going to be chipping away and adding to your portfolios. And it's money you never would have had. It's money you never would have had. But we want to keep that risk really, really tight. So gold opportunities, long and short. Download. Now, next up, we're going to get straight into the stocks. I don't want to risk going into anything else now. I just want to get the stocks ironed out. So US 30 Dow Jones first and foremost up here. Take a breath for a moment. So we've got the high up at the top. We've got the lows down at the bottom. Now the lows, this is a pretty choppy range, and I don't like the fact that we're trading right bang in the middle of it. That's never a good sign. I'd much prefer to be up at the high or down at the low at the point where this pings. Yeah, to be honest, that's not so great, actually. Let's look at the NAS 100 here quickly. So NAS 100 highs up at the top. So I think we can certainly work with this one. There's a clean ascending level in there somewhere. But I don't know if we should try and focus more of our attentions on areas like this, for example, because that point, even though it's really choppy and it's not a nice looking chart at the moment, it definitely looks like an end of quarter chart, that's for sure. But it does provide the opportunity that we seek even through the mess, because if we look at a BOS approximately there, that's quite wide, isn't it? We are riding on the fact of the news here, guys. So what we're going to do is look for a short. A short's going to be down there, targeting this level with a stop loss at about there at 21,903.55. Probably increase that a little bit, make that 1 to 3. So that's a 1 to 3.2, excluding slippage, going to be grossing a 1 to 2.6. Really random and approximate figures here. We have no idea. We might actually get a really great entry. We don't know, but it's always good to think like that, so you're not disappointed afterwards with looking at what you've actually realistically earned. And so that's going to be the short for the NAS 100 based on the analyst expectations coming out correct, which I think there's a greater chance of than the numbers being a miss. And so that's going to be my NAS 100 trade. How are we doing for time? 125. Okay, one more minute and then I'm going to start punching numbers. And so then we've got the S&P 500 as well. Looks a little bit more similar to the NAS 100. We're going to start looking at, come on, there we go. So we've got the high up here at the moment. we've got the primary low, which is right the way down there. That's a big trading margin as well. And then I'm going to be looking at the breaker structure access point for this one. That's going to be a little bit more lower than the NAS 100s actually, guys. So I'm going to have that there. Now this is really quite far into the margin here, but that is what it is. So I'm going to be targeting 59.95. That's going to be 25 pips or so, you know, with slippage, of course. We don't know. That's going to yield a 1 to 2.8 as the static trade is currently. So that's going to be my short in the S&P 500. I am actually going to have a long breakout in the S&P 500 as well. No retest required, just looking to punch a hole above those highs. So I'm going to have a fixed 1, 2, 3, which is going to be that trade idea there for the S&P 500. That's just going to be a fixed trade. I'm not going to do that for the NAS 100. Yeah, I'm not going to do that for the NAS 100. That's only going to be the S&P. All right. So, guys, it's now currently 1:26. We've got a few minutes to go. I'm going to start punching some numbers in to my terminal and get ready. Quickly. Right, we've got to get going. Got to get going. All right. All right. We're good. We're in. So, we've got a minute and 50 seconds to go. Going to get ready. Let's hope it's an event. I really am hopeful that it's actually going to be an event of worth this afternoon. You know, I really do. It's been a painfully slow week so far. Not for the sake of not gaining or losing or anything like that, but just because there's something going on. So, really hopeful. Really hopeful. Always optimistic, me. All right. Now, remember, guys, I'll get the data slightly earlier than you. I mean, obviously not if you're watching a calendar. But in terms of me translating the information to you, it will come out here because of the delay in the stream. It shouldn't be that much, only a second or two. But all right, 50 seconds to go. All right, 20 seconds to go. All right, 5 seconds, guys. 4, 3, 2, 1. Wow. Big miss on the monthly figure there. 0.1% down from a 0.3 expectation. It's only a 0.1% decline from the prior figure. 2.8% core inflation annual rate, which means stability. And we've got the annual base rate down here at 2.4, which is a 0.1% increase. It's a real mixed bag at the moment. The base rate figure is probably going to shake things up a little bit, but we've got a lot of stability in the rest of the figures here at the moment. The base rate for monthly is 0.1%, so that's a 0.1 decrease on that one as well. So we actually have a decline in core inflation monthly rates and a decline in base inflation monthly rates as well. In terms of the annual rates, the 2.8 is stable from the last print, and we've got the inflation rate down here, which is the 0.1% increase. So it's a real mixed bag at the moment of data. Let's have a look at what it translates to in the charts. S&P at the moment is going for it. Let's not hold out on that one at the moment, though. This is a real mixed bag of data here, so we could see just as much of a volatile crash as we did the rally. NAS 100's obviously taken off like a rocket. Gold in this case, though, looking at this, is now almost at the red. It has triggered and is almost at the red. The entries, from what I can see, have actually been pretty good. The slippage on that, so that was what, 53.77. So that's not actually too bad. That's really good. Whoops. Come on. Oh, I hate doing this. 53.77. Alright, I'll fool around with that afterwards. Yeah, there we go. Yeah. Right, so that's the S&P at the moment. Gold. Yeah, it's looking It's looking like a stretch, that one. A real mixed bag of data. To be honest with you, it's probably the worst kind of data that you could expect, unfortunately, because any meaningful gains that could have been caused as a result of the data have been counteracted by the other half of the data. So it's a shame. It's a shame, really. We are getting a bit of a drop in the DXY. That's coming down here at the moment, being a little bit more reactive to the cooling off immediate figures. The monthly figures, that one is. Looking at the Euro USD, it should be in a position where we've achieved liquidity. So that's one thing. Euro USD has actually gone for quite a decent pump here, straight up into the big money. So we've got a lot of cash probably triggering in the market at the moment. A lot of pending orders and limit orders are being triggered right now. Probably looking at shorts. You could go down to the 1 minute time frame here and actually look at taking this all the way back, so long as your spreads are okay. It is the Euro USD, so even in these times with a wildly varying spread, you're still going to be okay with the degree of variations that you see. So you could possibly look at potential shorts in the EU soon enough to trade the corrective. I don't think the news, to be honest, this afternoon, guys, is actually... It's not the kind of news where we're going to see big moves continuing through with the follow through. So we'll have to go back. I'll have to go back to that one and check out this S&P. Yeah. 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 I need to hang on a minute. Do some admin here. 1.19. I tell you what, that's bloody good actually. That's not bad at all. Well, actually, that was a 1 to 3.2 and it's now 1 to 2.6. That was actually great. To be honest, that's what I said. I said it was going to be about 1 to 2.6 as a result. So yeah, it's not too bad. All right. Well, look, things are happening. Gold's moving at the moment. We've got the S&P 500, which is kind of underway here. It's doing well. It's holding its ground. We're also trading. Don't dismiss the fact that we have also broken through major points of liquidity, and we are well positioned from a technical perspective above these points of liquidity. So we still have defenses. Even it might be a news event, we might see that big correction, the big correction come back on us, but we still have lines of defense open at the moment. So look, I think it's, regardless of what happens, I'm really happy with the bloody entries today. They've been really good. The thought process of where we would be in terms of the slippage and the spread variations were really on the money as well. So and we're still yielding some really decent returns here. I mean, if we get these through, we're going to be up way more than we'll be up 0.7% off of these trades. So I think that's certainly worth a call out. The NAS 100, I should have had a bloody long in that one. I mean, that would have been a trade, wouldn't it? Let's face it. There's no doubt about that one. That would have been a trade. Probably done and dusted in that space of time. I didn't want to go too crazy though and have a load in, things like this. You have two trades both long at the same time. In the US indices, they're more likely to both, if the market takes a dump, they're both gonna dump on you. Right, so what we're looking out for here, let me just explain the thought process here. What we really want to be looking out for is a break of structure above this high. If we clear out this high that was at the forefront of the price action pullback that we just had, we should, in theory, be pretty much there. It should be plain sailing right to that 6078 point on the S&P 500. So that needs to happen for us to get the confidence we need in order to see the rest of that trade done. It looks close to it, but this is the decision point. So we're not out of the woods yet. This is still high risk until we get the break of structure above that sort of 6071, 6070, 150 point. Looking at gold, we want to be looking left, really. That's where we want to be with gold. We want to be going all the way back here. And we want to be thinking to ourselves, right, the most sort of significant point of interest is going to be this low. That's the stage in which the market had this big rally, right? So that's going to be the major point of inflection from a technical perspective again that we want to be watching out for. So I'm going to drag that one right, and as you can see here, we're actually forming a bit of a wall, aren't we? We've seen a lot of rebounds, we've seen a lot of retests on the way back down again. So this is going to be a level of significance in gold. So then we want to drag that one right away across to the right hand side. We're going to watch the market come back away from this level a couple of times. There, look, see? It's already happening. So we come up to these levels, and the reason the market drops off, it's not profit taking yet, it's because of the limit and pending orders that are in the market. Remember, the commercial institutions, they're placing their orders all over the place, not market order, because they can't afford to. Pending and limit orders at market are a much, much cheaper way to trade for commercial institutions, and so therefore, we find those points in time, those points of interest, we know where the money is, and we can see this translated into the future. So we can almost, have a good idea of where things are going to go down the line. So in order to get the confidence that this trade is really going to go to target, we need to say a breakout above this level at 33.63. That's when we're going to get confidence. That's when we should be inspired. But at the moment, yeah, we're still the high risk points. Look, we've had another rejection from this level, but we've got a lot of bull power on our side at the moment. We want to see the breakout of this level. This is it now. This is it right here. See how it's come away? It's shot away from there quickly. You got to think there's money there. Short money. What we need is the aid of a couple of whales to just punch a hole straight through. Looks like it could be going for it. And what you guys can do, if you are currently in these, is say, for example, in this S&P 500, we've got this low, don't we, right? So now we've got a margin of availability really with the S&P. What you can do, I'm not going to do this, okay? I'm not going to do this. My trades are, once they're in, they're gone. It is what it is. But what you could do is bring your stop loss up to a nice margin underneath that level in there. That way, you are 100% cleared. The trade comes down, you've still made money. No matter what, when you move your stop loss there, you are green. And green is good. So that's something you can do. In terms of gold, at the moment, it's a little bit more difficult, gold, frankly. Especially with mine because of the slippage. We were at 1 to 3.2 and now 1 to 2.6. Yeah, look at this market, eh? And dropping away at the moment, isn't it? Gold, you do have this high. Okay, which is the trigger high. This one here, the 130 candle. If you look at that high there, you can, in theory, bring your stop loss up to around 33.49. This removes 50% of your at-market risk. And so, therefore, you're going to go from 0.15 to 0.045, whatever it is. 75, sorry. 0.075. So, you're taking it right down, then you're scaling out. But, we risk 0.15% on these trades for a reason, guys. It's for a reason. But if you want to bank some, you bank some. I'm definitely not going to tell you off for doing that. Yeah, see, punched a hole, it's come back down. There's protection up here. There is commercial protection up at these levels at the moment. Let's go to the 15 minute. Let's go to the daily. Sorry. Can't go back in time that far. So, let's see where those highs is. So, if you look at here, you see like this area, right? This area in price action. You see, if we zoom in there, look how many candlesticks were here, the daily candles. They were up here for a long, long time trading against this area. Commercial money. Very cash-rich area. It's not the cash-rich area. The cash-rich areas, the primary inflection points, are 1 and 2. That's the big ones. But this is very, very important. So if we drag that one across to the right-hand side, there's no doubt that we're going to see some kind of reaction to this, some kind of technical reaction, right? The market's come up here, it's stuck its toes in, and it's now getting quite a sharp rejection. If we go back down to the 1 minute time frame again, look at the S&P now. Right? Now, this is daily. I don't necessarily believe in the fact that a candlestick dips its toes in like that and it's instantaneous rejection. It really needs to get, dig deep. So that daily zone is probably about this wide, in theory, which is where the money is. It's not that thin. So I'm still confident. I'm still confident in the S&P. We'll see. We'll see how it goes. Gold at the moment, though, not looking healthy, is it? It's having quite the pullback. Let's have a look at the dollar. Problem is with the dollar index here, from a technical perspective, from a commercial perspective, is we're down at this floor. That's the problem with the DXY. Yes, it's a really nice big candle, but we have now just traded into a bunch of bull liquidity. There's a load of long orders in the market down at around these areas. How do we know that? Well, look at the charts. The information's right there. So now we're looking at the potential correction coming in. So the CPI event's taken place. We've got the initial volatility strike, which is what we've been in, which is what we traded. But now we're going to get the correction. And generally speaking, if the data is not prominent enough to create market follow through and consistency, then you're probably going to end up right where we started, which is what we see a lot of the time, which is when you look at it in hindsight, in history, it looks like V reversal, where the market instantly sells off and then comes back the other side right to where we started off. And that's problematic. But like I said, we've got some big levels inside our stop losses. So yeah, so I'm not gonna mess. Right. Well, I think that's basically the event there, ladies and gents. In terms of what's going on this afternoon, of course, we do have the full EIA batch of data at 3:30 this afternoon. So do be aware of natural gas, which will be probably quite the strikeout, I should imagine, from that. Look, this inflation data at the moment, I think from a fundamental perspective, will not increase. I don't think it will increase any kind of pressure on the Fed from the White House's perspective. I don't think there'll be any kind of revisions from the Fed at this stage as a result of it. I would arguably say that the Fed might use it as a short-term win. We might see the next Fed press conference or minutes actually be a little bit more hawkish than dovish as a result of this. The outlier here is the 0.1% increase in the base rate annual. Okay, the annual base rate down here, this one. Okay, this is the outlier because it is the 0.1% increase that shakes things up. We, of course, core inflation minus 0.1%. The base inflation monthly figure minus 0.1%. So we have had a decline in those immediate figures, which is why I think the Fed might have an initial and immediate response of what we're doing is working. But then the reality is going to set in the fact that the annual flavor is still there. So that's going to be interesting to see and what they think is what they feel is going to happen with that. The other thing as well, of course, is the core inflation annual rate is 2.8, which is stable, no reduction. We shouldn't see that. We should be looking at that coming down on their journey to the 2% target. But that's for the future. And that's more commentary to follow on that one as time goes on and as we see the Fed. Braden, going to get the rest on catch up. Max having internet issues here. Have a good day. No problem at all, my friend. I hope you have a good day as well, and good luck with the net issues. That's absolutely fine, mate. Yeah, no problem at all. So that's where we are then, team. So in terms of building anything else today, I'm going to leave the exposure in the market at the moment. We've got gold, we've got the S&P 500, both of them looking like big correction markets at the moment. It's not great. You're absolutely right. We're actually coming back for a counter break, close and retest on this one, so it definitely doesn't look great. I'll post the results, always do. It'll be in the track record anyway, fed straight through onto the company's track record page, so you can guys go check it out afterwards, whatever. But anyway, the results will be posted inside the trading community, and we'll see where we go from there. In terms of the rest of the markets, not going to be looking to take any particular trades this afternoon as a result of this afternoon's CPI event. Going to wait for the dust to settle before re-engaging in the markets tomorrow for the second half of the week. And finally, for this US session this afternoon, what time are we at the moment? 10 to 2 or so. Yeah, I want to wait to see what the US is going to say. I want to wait to see what the US market's going to say about it. It could be a potential short here in the NAS 100, might be on the cards. If it doesn't trigger before the open, you could potentially short it from 22.018 back down to 21.97. But frankly, I would honestly wait. I would really wait until the US bell rings. Let's have a look at where the markets are. Let's have a look at what the US think of the data. And then we can make a decision from there. So, yeah, and we'll take it from there. But I think that's going to be it. Yeah, I think that's going to be it for me today. Yeah, everything's coming right the way down now. My terminal's turned from a wall of green to a wall of red. Not very happy. No, it'll be fine. It's fine. So I'm going to wrap things up there, guys, for this afternoon's CPI event. I hope you enjoyed it. I hope it was entertaining. I hope you took away something regarding the thought processes and how we navigate these quite relatively complex news events as well when we're trading the markets. Look, you win some, you lose some. If it wasn't profitable long term, we would exclude it from the portfolio strategies. Bottom line is it is profitable, so we just got to take the wins and the losses. You know, you've got to take them together. You can't be bent out of shape out of it. And we're not at stop loss yet. Anything can happen. So let's keep our fingers crossed, see how things go this afternoon. If there's anything of real prominence this afternoon in the US markets that I feel like, you know, you guys really need to get stuck into, I will post it out there. But I think it's going to be a relatively a session of mixed volatility. As we get to the end of Q3, things have really, really slowed down. We are seeing a lack of consistency from price action at the moment, and you need to pay attention to these things. You know, they're all cyclical, so you need to pay attention to these things and re-engage when the time's right. You know, so that's absolutely fine. So take care, guys. Have a great afternoon. Again, I hope you've enjoyed the event as much as I have, and I look forward to seeing you in the next one. Catch you then. Bye-bye.